we probably will lead into this. When I'm thinking about, big potential events that could come up in the future, and there's a lot of talk about the real estate market and the exposure to banks. Are you guys already starting to think about, how do you guys position portfolios? That may be a year from now, it may never happen, but obviously a lot of these buildings are very underwater, and that could potentially create a lot of pain for the banking, system. So how do you guys, plan around that?
Yeah, that's certainly one of the risks that I think everyone agrees is out there and brewing, right? Because you have seen a pretty fundamental shift in usage and in support for certain areas of the commercial real estate market, primarily in office.
Yep.
But I think first and foremost, it's also important to remember that the sort of transition in office space started before the pandemic. Right. This was a process that many companies, government agencies, municipalities were going through to sort of say how we can and do work is changing. Remote work didn't just start in 2020, right? People had been working remote. People had been traveling. You're moving to sort of a more hybrid model or office space that's more modular, so that instead of having 10 offices in a city, an organization might have 2 and people can sort of come and go. So those things were already in place. Certainly the pandemic has accelerated that. And there certainly were players that maybe weren't on that wave that were sort of thrust upon it by the pandemic and the work from home and the remote work phenomenon. But we think that, so it's not new, it's been accelerated. So careful credit work should be able to help us find properties and CMBS, commercial mortgage-backed securities, that we think are in great shape. There are certainly marquee properties. There are great offices around, in every city in the country where, you're going to have no problem finding tenants and filling the building, and they've got great amenities, and it's state of the art, and it's been remodeled, and you're happy to go to work. Maybe you don't go 5 days a week right now, but over time, maybe that changes.
Yeah.
But there are probably properties that haven't had the level of investment, that are a little older, that are a little weaker, that they're in, areas or neighborhoods where maybe there hasn't been as much investment. And so I do think there's going to be challenges in the commercial real estate sector broadly. I think CMBS in general is an area where you want to be cautious. Yep. But that's one of the great benefits, I think, that active management and fixed income investors like us and our peers can really add value in, because we can do that credit work and look through to sort of understand which properties are we invested in, which ones maybe do we want to avoid. And it's certainly an area where I would not want to sort of just buy a basket or an index or go passive. And to your other question, Carl, I think you're right that the impact of the eventual sort of settling of commercial real estate issues will weigh on regional banks, right? Smaller community regional banks own a disproportionate amount of that paper on their books. Yep. But, the kind of good news there is that there are thousands of smaller and regional banks across the country, about 4,000 banks in the US. And so that risk is diversified. I think there were a few key players that we've already seen have challenges where they had very concentrated customer bases or collateral types that really made them more susceptible to challenges. But your average sort of community bank, may have certain properties on their books that they're going to have to deal with. But I don't think the sort of the most likely outcome is a mass collapse in all at once commercial real estate and office properties that has an immediate sort of massive impact on the banking sector. So again, I think careful credit work, understanding sort of who owns what, where those properties are, what are the obligations to the banks, certainly will provide opportunities for certain banks to do very, very well and certain banks to be more challenged, but probably not in at this point, we don't see it as a near-term systemic event, that we have to kind of come out and really all hands on deck react to as a market. And I think that's going to be a bit of a shift for a lot of investors, because the last several years, the Fed, different regulators have sort of ridden to the rescue much more quickly than they did. If you think about the financial crisis back in 2007, 2008, it took the Fed and Congress and regulators a year and a half to really sort of come to grips with what was happening and come up with responses and formalize support. And in COVID, it was a matter of weeks, days. You know, with some of the regional banking issues that we saw in March, it was over a weekend. You had regulators step in and sort of slap band-aids on and guarantee deposits and take forceful action. And so if the Fed is serious that they need to hold rates high for a period of time, and that they know that is going to cause some challenges, they're telling us they're going to let a little bit more of those challenges through. They're going to have to let some weaker players or banks that are more challenged and companies that are more challenged sort of have problems, right? That we're going to see the default rate tick up. We're going to see some banks have issues, but I don't, right now, we don't see it as a level where we're worried that, you know, again, the financial system is going to collapse, or that the Fed and global regulators have to ride to the rescue, you know, immediately drop rates to zero and sort of give us all this emergency support. We've got to get back to a place where there are winners and losers. You know, the rising tide doesn't lift all boats everywhere all the time. And that's why you do need to be more discerning with your investments. And we need to do our work so that we can pick and choose those credits we feel we're getting compensated to take risk. And ones where we think the risk is too high, we avoid or wait till the price gets better.